National Stock Exchange of India has been actively involved with initiatives to educate the young generation of our country on the importance of financial management. One such initiative is NSE FinWiz that focuses on educating and advising the young workforce of the country on wealth management to enhance financial literacy and to empower
Insurance
them.
is for protection and investment is for growth.
Another program facilitated by NSE IPFT is NSE Financial Quest. This inter-school financial quiz contest goes an extra mile by educating the young students on fundamentals of finance.
What is this?
It's the formula for the simple interest.
Simple interest is the right answer.
Under the NSE Financial Quest Base Camps banner, the program engages students around the year through workshops on various topics, projects, interactive videos and quizzes.
DiCaprio is bouncing checks off hand hand.
Plus 75 Plus 75.
To facilitate these two programs, NSE along with CNBC TV18 has travelled across the country to bridge the wide knowledge gap in terms of finance. In this episode of NSE FinWiz, we are all set to achieve our objectives once again by gauging young professionals in a new city.
Hello and welcome to Season 4 of NSE FinWiz powered by CNBC TV18, and I'm your host Nitya Balakrishnan. Today my team and I have travelled to the lush and green city of Mangalore to one of India's most formidable IT services companies, the learning centre of Mphasis in Mangalore.
Mphasis is a leading IT solutions provider offering applications, business process outsourcing and infrastructure services globally. Mphasis encourages its employees to be part of special courses which combine knowledge and expertise. The training centers of Mphasis serve the learning and development needs of next-gen employees. A wide range of courses are offered to keep them updated with the latest advancements in their field. NSE FinWiz along with CNBC TV18 visited the Learning Centre of Mphasis in Mangalore to understand the thoughts and notions of the young trainees on wealth management and financial planning with the theme Dreams Come True.
My short-term goal would be like to collect as much money as I can so that for my long-term goal, that is I want to start a company eventually so that I can have that much of money to invest and get started.
I want to invest in mutual funds, provident funds, and I'm thinking of investing in a provident fund for 20,000 because that gives me a way off in my salary also, income tax returns, and I want to invest in mutual funds for a 3 years plan and long-term investment of provident fund for 20 years and then mutual fund investment for a 5-year term.
My short-term goal is to buy a Ducati, and my medium-term goal is to go on a foreign trip with my family, and again my long-term goal is to start a business of my own.
The short-term goal for me right now is to have a sustainable growth in my career, and long-term goal is to have a well-settled life before 35, and any transitive process from short-term to long-term goal will come in any mid-term goals for me.
Hello and welcome to Season 4 of NSE FinWiz powered by CNBC TV18, and I'm your host Nitya Balakrishnan. Today we're in the Learning Centre at Mphasis Mangalore, and I'm joined by two very special guests, Harshvardhan Rumta and Lavai Navlaki. Thank you so much for joining us today. And let's throw open this discussion with the very basic question, because we're talking to a very young group of 22 to 25-year-olds here in Mangalore. So the first question that all of us have on our minds is, when is the right age to start investing? Is there any such right mantra?
Today, I think is a good time because you couldn't do it yesterday. I think the moment you start earning is the time when you start planning, saying how much of that earning are you going to spend and how much can you save. I think we typically start by looking at what our expenditure is, and at the end of the day say, oh, I got 100 rupees of income and I spent 99 rupees, so I have only 1 rupee left to save. It may be a good idea to start looking at and saying, no, my target is to save 10 rupees initially and then 20, and then try and curtail some of your expenditure around it. Because the more you can put aside to invest and the earlier you can do it, the impact of it is substantially better as you go forward.
So work backwards with a set goal in mind.
Yes, I think a saving goal is probably more important than what's the balance available.
Well, before I bring Harsh into this discussion, how many of us here actually set aside an X amount, however little or lot it may be, towards monthly savings? So Harsh, one question I'd like to ask you is, a lot of us are not aware of the new age vehicles to park our funds. So even if I have set aside 500 rupees every month, I just let it lie in my savings bank account to use at a later stage for whatever is needed. Talk to us really about where all we can look at parking our funds.
Let's understand a situation that even if in the worst case scenario, you're going to be able to save about a 500 rupees a month or 1,000 rupees a month. So let me give you this example. If you were supposed to park this 1,000 rupees a month into an equity mutual fund, okay, you put it in an SIP format in an equity mutual fund, and you set this aside for a period of say 30 years. Okay, if equities give you a return of about 14% compounded annually, what is this 1,000 rupees likely to become after 30 years? So over a period of 30 years, you have invested 3,60,000 rupees.
Sure.
If it compounds at 14%, the money that you will get at the end of the 30-year period is going to be about 54 lakhs. If you delay this investment for 5 years, so which means now you invested for 25 years instead of 30.
Correct.
The same corpus would reduce, right? The earlier where you were getting 54 lakhs, now because you've delayed it for 5 years, what you will get in your hand is about 26.5 lakhs. So it becomes less than half.
Absolutely. So the power of compounding as well as the importance of starting early in one. Fair enough. Now if I can ask Harsh to jump in on one thing that all of us will really be interested in here is when we get that pay slip and at the end of the year, you're talking about that exemption, tax exemption under ETC. And that's when everybody rushes to go ahead and see whether I can pick up insurance or what, ELSS, etc. What should I park my funds in? Because a lot of us are not aware that you are eligible for that kind of exemption. So talk to us really about the exemption under ETC and what are the options that one can look at investing into to avail that exemption.
So the idea is within this gamut of ATC, section ATC, there are all kind of products available. So if in case you want to invest in a product which is very safe in nature, you have PPF which is offered. If you want to buy a life insurance policy, even life premiums that you pay for a life insurance policy are eligible for deduction under section ATC. If you want to save for retirement, and we've spoken about investing into equities for long term, you can also choose an ELSS, an equity linked savings schemes. So this offers you the tax benefits and also does what actually the money is supposed to do. So what you need to do is very wisely look into the provisions and the products which are available. If you need money after say possibly 6 or 7 years, there are post office deposits that you can make. There's a bank fixed deposit which you can invest into, which gives you ATC benefits and has a lock-in of 5 years of time.
Absolutely. In fact, can I take a quick show of hands? How many of us here are invested into the stock or equity markets? So that's a bare minimum. One of the apprehensions that a lot of people have, Mr. Navlaki, is that with investing into equity markets or the stock markets, there is a lot of volatility involved. And as a result, I'd keep my money where I know it's safe and I don't want to invest it in a tool where, it can tend to fluctuate. Talk to us about the basic premises that we have to keep in mind when we decide to go in and invest in the equity market, and what are the benefits of such an investment?
There are 2-3 ways of ensuring that you sort of reduce the risk of these markets. One is that if my goal is 5 years, then I know that my money that I am putting aside is being invested and kept aside there for the entire period of 5 years, and I am not going to keep watching and say, Trump got elected, market's fallen, let me pull out the money, and the next day the market's gone up. So, you'll be caught on the wrong side of the fence. The other thing is that equity risk is always that I bought high and I'm selling low. So what do I do to cut that risk is that I say I have 100 rupees to invest. Instead of putting all 100 rupees together on one day in one stock or in one mutual fund, I will spread this money across the next 3 months, next 2 weeks, next 14 months, whatever time period that you have ultimately for your investment, so that you have staggered the entry level. The longer the period that I have for equity investment, the risk of losing money comes down. The average rate of return or the band that I am getting is sort of much narrower than if I was investing for 1 year.
All right, on that note, it's time to slip into a quick break right here on the show, but stay tuned. We have a whole host of questions on real estate on the other side. Welcome back in conversation with Harshvardhan Rungta and Lovai Navlaki here in Mphasis Mangalore, and it's time to throw the spotlight onto our core sector. We're talking about investment into real estate. My first question here is, are you for it, or do you think investing into real estate, given today's scenario, is not something that needs to be primarily one's focus?
So our take is that at any point in time, if you're buying real estate to live in, go ahead and do it. That's at any point in time, because you will probably look for something that has certain features. And if you found it and the price is right, you can go ahead and buy. Because typically, when you're buying a place to live in, you're there for the next 10, 12, 15 years. So even if you've got it at the wrong end of the cycle, hopefully by the time you sell it, you will sort of make sure that you sell when the cycle is up. So that's at any point in time.
All right, a quick show of hands. How many of us here aim to, at some point in our lives, own a house of our own? Harsh, that's the interesting thing here. 100 out of 100 hands up in the air, because it's such an inherent Indian, quality to want to own a house. But given that today's day and age, we work in very different professional scenarios, where probably your roots are not always going to be in the same place. Given that kind of scenario, is it, justified to have this notion at the back of our heads that I must own a house of my own? And talk to us about investing into real estate purely as that. Would you recommend real estate over other kind of investment or saving options, say, for example, the equity markets?
So, well, Nitya, at some point in time, we want to have a house of our own. Well, that part is understood and it is well accepted. Because, you may continue to live on rent while you're professionally engaged. But after retirement, you again want to come back into your own house. So when we talk about owning a house, there is no harm in aspiring to own a house. Now the question arises, do you own a house with the first income that you get? Do you commit to a housing loan the moment you get a real, substantial income in your hand, which could be like maybe 2 years into a job? So the answer to that is no. The reason being, because you've just got into work, if in case you were going to commit to a house in the initial years of your earning, a major portion of your income will go towards EMI. The minimum ticket size that of a residential property is reasonably large to suck out almost all the liquidity that you have. So in case you do that at the beginning of your career, then you will have no money left to invest into any other asset class. And in case you're investing into a product which you're going to possibly require after retirement, for which you're committing today onwards, and which is leaving you with no liquidity to invest in anything else, then it's not making sense. Besides the fact, you have to understand, real estate, even otherwise, is a cost-consuming asset. While you own the house, there are your regular property taxes to be paid, there is maintenance of the property, there is depreciation of the property. So it also entails a certain amount of cost associated with simply owning it. So growth is another element that we're talking about. So growth is dependent on market circumstances, and whether given in the current scenario, whether there will be appreciation or no, we're not answering that question right now. We're only trying to see from a personal finance perspective, should I at this stage in my life commit more than 50% of my income towards an EMI?
Sure.
Most certainly not. You need to have a balance. You need to put into assets which are liquid and growth oriented. And when your income increases substantially over a period of time, when you're mid-career basis, maybe at that time you can think of committing certain portion towards owning a house. So I think that's how you should be planning it right now.
Absolutely. If I can get Sayamdeep Roy, who's in the software development here, how is the real estate market going to be looking in the next 10 years? Now, this is a query I want you to answer, because crystal ball gazing is something that everybody, seeks to get answers to. So the query is, how will it look in the next 10 years, and will investing in land be more profitable than buying gold?
So I go by history, and I think that gold as an asset class typically gives you returns which are inflation adjusted, or it's supposed to. over a long period of time, actually it has been below inflation adjusted returns. So if I'm looking at returns, probably land is sort of a cleaner asset. All the negatives that Harsh spoke about earlier about properties being depreciating, etc., don't come into play in land. Now the question only in India is whether the title is clear, whether there will be no encroachment. Those are types of things that you have to worry, because you'll invest in it, the price has gone up, but when you go there, you suddenly find that that land is not available for you, somebody else has gone and parked himself there. So that's probably the only negative, I would say, and if this is a straightforward answer to land versus gold and nothing else.
Now, if we can have Anirudh Krishna, who says, with real estate stocks hitting their lows and with new and strict Supreme Court guidelines in the sector, is it safe to enter into these stocks for the short term, considering we're talking about real estate stocks?
In stocks, I would only say this, and you keep this in mind when you're going to buy any stocks for that matter. It's better to pay a higher price for a good company than to pay a lower price for a bad company. You know, it's no harm in paying premium to a company which has got business prospects, you know, which is good in corporate governance, because that's the growth will continue over there. And on the other hand, if there is a company which is not doing well at all, and just because it has hit an all-time low, you don't go and buy it. There's a reason it has hit an all-time low.
We've discussed investing into the real estate sector threadbare, but it's time to slip into a quick break right here on NSE FinWiz. A whole host of personal finance queries on the other side. You've tuned into NSE FinWiz in Mphasis Mangalore, and it's time for Personal Finance 101. A quick show of hands. Can we have microphones to the people with questions? Yes.
Hi, this is Dipanshu Gupta, and I have a question that being a fresher and I haven't invested in anything now. So what are the major basic factors which we have to look upon? Likewise, I have to buy up land or I have to invest in some property. So what are the basic things which we have to look first?
So like I said earlier, I think the basic thing that you need to do is to set aside a savings budget and first put it aside. The first possible thing with the quantum that you might have available would be to invest in mutual funds. The type of mutual funds could vary depending on for how long can you continue making that investment. So if you can continue making that whatever, so say you're able to save 5,000 rupees every month, but you know that 2,000 or 3,000 rupees per month you can keep aside for the next 5 years and not touch it, and that goes into equity funds. Then you say, okay, the remaining I might need the money at any point in time, or in the next 6 months I might need this 1,000 rupees a month. That goes into money market fund. The remaining can go into a debt fund or a balance fund. But the only thing I feel is that in many of these cases, you certainly need to get good advice. So don't just Google or search it online and say, you know, I read about it, so this is the best thing. It may be worthwhile just talking to a few people. You don't have to pick them as the advisor, so you don't need to worry that, oh, it's going to cost me so much to get that advice. But talk to a few, you'll be able to zero in on somebody whose advice you can take and then decide where to invest that money.
I wanted to say that I have a recurring deposit with HDFC right now, but I want to switch over to SIPs. So what is the right time to do so? If it is not now, when is it?
So, well, the right time to switch into an SIP is today. I mean, there is no reason you need to wait and time the market, especially when you're going to invest into in the form of an SIP. The reason why you're doing an SIP is because you do not know which side the markets will go. Had I known the markets are only going to go up from here, I will not do an SIP. I will invest in lump sum because I'd like my entire money to generate that kind of returns. If you're going to invest in an SIP, the reason you're doing it because the markets will fluctuate and you do not know it could even go down tomorrow. So only a portion of that money you want to commit in current market levels. So the idea is you move to an SIP instantly. I mean, you move immediately. Why would you need to wait and even think about it? Provided the purpose of investing into this equity mutual fund or SIP is going to be long term. If you're doing a recurring deposit for 1 year, you do not compare it with an SIP in an equity mutual fund.
Lovai Navlaki and Harshvardhan Rumta, it's been an absolute pleasure chatting with you. And from all of us here at Mphasis Mangalore, goodbye and thanks for watching.
I like the event because I'm a fresher as an IT as well as all of this. So it is very necessary to have this kind of knowledge about all of the investment and mutual fund and stocks, because we are getting our first salary. Now, we just got our first salary, and it is very important for us to know how to channelize the money for our future use.
It's very important to know where how can I multiply my money. So that could be the basic knowledge for how can you invest.
Event was great. I get to know more about savings, how to save my income and to get most of it, and to know about my medium-term goals, long-term goals and the short-term goals, and how I can save my money and to get the best of it.
Focus, ideate, innovate, enable.